we're going to be talking about loans and lines of credit because we must know above everything what we're asking for when we go to that bank, because they are going to try to talk you into a loan. Every time you walk in to get a line, they're going to say, but we have a loan and the interest rate is so much cheaper. So we're going to go over why that is. Okay, so let's talk about what a line of credit is. A line of credit is revolving. That means it's open-ended. A lot of people do not understand what a line of credit is, and I did not either. When I first got started, I had no idea that you could put money in and pull money out of certain tools at the bank. I thought they were all, you got an amount of money, you got it put into your account, and then you spent it, and then you started making payment. I thought that's what everything was at the bank. If you're with me, please let me know, because I felt really dumb, and I have people come to me all the time, and they're like, well, I don't understand. Why not just get a loan? It's just because that line allows you to revolve it in and out as many times as you want to, okay? So we're not stuck to a loan that we get to use one time. We can put our money back in, pull it out, and use it again. I absolutely love that. It has literally changed my life, and lines of credit are beautiful. They're also simple interest. Now the loan, I don't even know, there's a glare right there. This says loan and it says close-ended. That means that when you have a loan, you have taken an amount and now you have monthly payments. And when you put in a payment, it is gone. You do not get to see that again, okay? That's close in. That means it goes in and it's stuck and you cannot pull it back out. So lines of credit are open-ended, meaning you can pull them back out. Close end is like your mortgage. Once you make the payment, it's gone. Simple interest on a line of credit compared to compound interest on a loan. What does that mean? Anything that compounds. We know what that word means or infers just by the word itself. It's compounding, right? So it is growing interest month on top of month. Some of these title loans, you want to call them a loan shark, but I don't think they're considered a loan shark, even though they ought to be in jail for what they do. But some businesses will take these loans and they're at a daily rate. So they're compounding daily, very expensive, okay? It's expensive enough to be monthly compounded interest. Now, the simple interest is figured on an average daily balance. So if I have a $10,000 balance today and I put $5,000 in, that means I've reduced the balance by $5,000. The bank does not figure interest off of your high. It doesn't figure interest off of your low. It averages it, okay? So, of course, the average would be $5,000, and it would average, or the interest would be multiplied or calculated based on the average daily balance, okay? So, over here, the compounded interest is in an amortized schedule. So that means that you have payments set up, same amount every month. If it's a mortgage, it's set up for 30 years. We have been duped as Americans because we're like in love with that mortgage because that buys our home. That's a lie from the devil. A mortgage is set up to rob you. So if your payment is $1,000 a month and you have today a 7% interest, a 6% interest, a 5% interest, you're paying over 100% in interest, okay? So that means that this payment right here would be going to interest, okay? The next payment, $999, might be going to interest and $1 to your principal. That's how the difference is with this simple interest on an average daily balance compared to this amortized schedule. Where the mortgage is dirtier than that is they take the interest over the 30-year period and they front load it into the first 7 years. Why would they do that? Well, if you statistically know that every American family is going to move within the first 7 years, then they're going to trade in the interest that they've already paid, reset it, and do it again on another mortgage. They know us. They've studied us for years, so they know that we're going to move within the first 7 years, or we're going to refinance in the first 7 years. So at year 4, they start sending you out letters saying, hey, you've got $25,000 available in your equity, so if you will refi to a lesser rate, So they'll say, you know, you're at a 4% interest rate. We're going to take you down to 3.5%. Or maybe 3%, and it's going to drop your payments by a couple of hundred a month. I'm sorry, but I have fallen for that in the past. So you don't have to raise your hand if you've done it. But when you do that, that is not to help you. That's not to give you a lower interest rate. That's not to reduce your monthly payments. That is to reset all of that interest that you paid. If you're down here at 950 is going to your interest now, and $50 is going to your actual principal balance. It resets it. Now you're back here. All of your money is going to the interest. So it is a scheme in the greatest form. I would like to shake the hand of the person that came up with that, because they are a genius, a billionaire genius. So be careful with these mortgages. They're not a joke. They're stealing your wealth, but we can stop it if we use this line of credit. Okay. So credit cards and loans are not lines of credit. A line of credit is a separate product. A credit card is a line of credit. A loan is not. A line of credit, a line, meaning that they have given you access to a line, meaning you can use it or you don't have to use it. If you're approved for a $10,000 line of credit, whether it be a credit card or a personal line or a home equity line, you do not have to use it. It is there for you to use. If you want to use $10 today and put it back tomorrow, you can. If you want to pull 10,000 out today and put 5,000 back tomorrow, you can. That's a line. A loan does not allow you to do that. Just like I showed you here, it's done. They write you a check or they put the amount into your bank account. So if you got a $10,000 personal loan, they wrote you a check or they deposited $10,000 into your checking account. You cannot put it back. If you do, you do not have access to it anymore. It's just considered paid off. Okay. That's the difference. Totally separate product, yes. How do you determine which debt to place in the HELOC? Is it the amount or the monthly payment? Good question. If you have a $10,000 credit card and you're paying $600 or $700 a month on that, then you're going to want to look at what it's going to do cash flow wise. If you already have $300, $400 in cash flow and you're going to gain $600 or $700 in cash flow by paying off that $10,000 credit card, you put it into a line of credit. So what happens? Your income goes in, it satisfies the payment. Now your current cash flow and the new cash flow you have from the credit card is going in to pay off that credit card, and it should be paid off in less than a year, even with the interest. Okay. So if you want me to show you that, if you have a $10,000 credit card and it has a $600 payment, you have a line of credit. You put the credit card into the line of credit. Let's say that you make $5,000 a month. You have $5,000 in income a month, and out of that you have $400, $500. Let's say you have $500 cash flow. So meaning that after all of your bills, all of your expenses, all of the allowances for the kids, everything is paid out of your $5,000 income in a month, you have $500 left over. Some people do not have any money left over. Some people are in the negative. So let's assume this one has 500. Now with the 600 that they just paid off the 10,000, they have $1,100 in cash flow. This is now in a line of credit. Your income, 5,000, would go into this line of credit. So this is income for month one. Your balance would be $5,000. So here now, it looks like that we're going to have about 3,900. 3,900 will be coming back out in expenses every month. So you're at 8,900. And if this is a 12%, this is where your interest would be figured. So you would figure 12% on the average, remember? So the average would be $5,000 because 10,000 was your high, 5,000 was your low. So 5,000 times 12% would be $50 in interest. So 8,950, then you're going to put your 5,000 in again. And that means that this one is going to pay off in less than 4 more months. So 4 more months, you would have, talking 6 months in having that $10,000 paid off that was sitting in a credit card that you were paying $600 a month on. If you read the statement, it will tell you how many decades it's going to take you to pay off a credit card if you're just making that minimum payment. So when you transfer it into a true line and you gain this monthly payment and now this is gone, then you see how fast your income and cash flow will pay down any line of credit.